This is Radio Free Wall Street with Lee Adler. Find me on the web at radiofreewallstreet.fm or at the Wall Street Examiner at wallstreetexaminer.com. Hi, everybody. This is Radio Free Wall Street for Wednesday, April 30th, 2014. I'm recording this at just about 4 p.m. New York time as the market comes to a close. Having rallied a bit after the FOMC announcement, which surprised absolutely no one, with another $10 billion taper in quantitative easing. That brings the monthly total to $60 billion that they'll be pumping in to dealer accounts. That includes $20 billion in MBS purchases, $25 billion in Treasury purchases, and $15 billion in the replacement of paid down MBS from the Fed's balance sheet. So the net increase to the balance sheet is $45 billion, but the net increase on dealer balance sheets in terms of cash is $60 billion, and that is still plenty to support the market. I don't think it likely that we'll have a major correction, and certainly not a bear market, as long as the Fed is pumping $60 billion a month into dealer accounts, and with the help of the Bank of Japan, which is pumping in something on the order of 80 or 90 billion equivalent US dollars into mostly the same dealer accounts. Now, today, as you can see, we're trying something a little bit different. I don't have a lot of time with my mother in the hospital, but I'm going to try to give you a couple of things that you'll find at least interesting, if not useful. And the first is I want to talk about the federal withholding taxes and what that implies for Friday's jobs report. And also I want to take a look at the chart of the Fed cash to primary dealers to give you some perspective on why I feel that it's unlikely that the market is going to have either a major bear market or a major correction, as long as the Fed is pumping this cash into the market. So let's get to those charts. Wisdom, the U.S. Treasury Department is kind enough to provide us with the daily Treasury statement, which comes out a day after the closing of the books each day and tells all the various revenues and expenses outlays of the federal government. And one of the key items I track is the federal withholding taxes, which gives us a good handle on exactly what's going on in the economy in real time. Maybe not exactly, but certainly gives us a fairly good idea of how the economy is faring in real time. Now, the data is extremely noisy, and I start first with an 11-day moving average, since the pay periods for most companies and employers is about half the month, and a month of work days is 21 or 22 days. Of course, a lot of people work weekends too. But generally, an 11-day period, the business days of the month are the only days in which the government collects taxes. So the 11-day period represents about a half a month's worth of tax collections. And that is this jagged line that you see here. And here's March and the beginning of April here. And then what I do with that line is I take a 4-week moving average, which is the red line, and that kind of smooths out these day-to-day fluctuations. And this chart shows the real annual percentage change, which is the actual change, and then I divide it by a factor which supposedly represents wage and salary inflation. And generally that's been around 2% on an annual basis. So the red line shows the 30-day or the 1-month average of that 2-week pay period average. And from early March through the end of March, the gains were typically running at about 5 to 6% a year, real, which is a very, very strong gain in wages and salary withholding, federal tax withholding. And so the most of the economists were looking for poor numbers in March, and they were surprised by the positive data, including the jobs data. I think that as a result of this, I think even the March number came in a little bit light for non-farm payrolls. So I would expect that there's going to be an upward revision for March. But of course, nobody pays any attention to the old data. They're only looking at the advanced data. for April that's going to be released this Friday. And as I often write about when I talk about this subject, that advance report is going to be revised multiple times over the years, both for the seasonal adjustment factor and the benchmarking and so on. And the first and second revisions each month are usually quite large. So it's really an unreliable report the first month, but everybody pays attention to it, and that's the way it is. So we look at that number, and apparently the consensus estimate right now is for a gain of around 200 or 210,000 jobs. Yahoo shows the data for Briefing.com survey of economists. They are looking at let's see here, Briefing's forecast is for a gain of 200,000 jobs. The consensus Wall Street forecast is for 210,000 jobs. And that's quite a bit higher than what they've been guessing lately. They've usually been around 150,000. The data itself has been amazingly consistent at about a 1.6% year-to-year gain almost every month, 1.6, 1.7%, which is kind of suspicious in its own right. But the data for April, it's a 210,000 gain is a fairly strong gain. Going back to looking at the data again, the data for April isn't that great. We've seen a decline from the beginning of the month, starting about here, to the end of the month. And by the end of the month, the real rate of gain was only around 3 or 4%, which is a lot lower than it has been. So there's probably going to be some slowing in the jobs data. I would guess that 210,000 estimate is probably a little too high, although these numbers don't always correlate exactly. So if anything, my wild guess based on the withholding data is that we're going to get a little bit of a miss in the jobs number on Friday. It might come out a little light of expectations. But at the same time, I suspect that March is going to be revised up. Not that any of this matters. It only affects the market for a day or two at most, and then the market goes back to following these liquidity. Speaking of liquidity, this is my chart of my proprietary chart of the cash that the Fed is pumping into the primary dealers in real time as these transactions are recorded at the New York Fed. And just starting back at the bottom of the crash in March of 2009, QE1 is here, and you can see the market rallied sharply. The Fed paused. We had a pretty good correction in the summer of 2010. Fed got scared, instituted QE2, market rallied. Fed paused again, market had a 10% correction. Wasn't doing much. The Fed got scared again, so it began the what they call the twist at that time, which didn't change the size of the balance sheet. But what it did was they decided that they would reinvest the proceeds of the payoffs of the MBS that they were getting as people paid off their mortgages, either through selling their home or refinancing. These existing mortgage-backed securities that the Fed held were getting paid off. So the Fed decided to reinvest those proceeds and purchase more MBS from the primary dealers, which resulted in this uptrend in the cash that they were pumping into the primary dealers each week. And the market responded by having somewhat of a rally for several months. But that wasn't enough for the Fed. At the end of 2012, it panicked, instituted QE3 with MBS purchases adding QE4 with Treasury purchases here in January of 2012, and it was bubble time in the market after that. Under pressure from certain quarters, I think Richard Fisher was having an influence at the Dallas Fed, and my friend Mr. Plosser at the Philly Fed, Chuck E. Cheesesteak Plosser. The Fed, the FOMC decided that it was going to begin to taper the rate at which it was purchasing securities under quantitative easing, and taper 1 and 2 went into effect at the end of last year, early this year. You can see that the slope of the line hardly changed at all. Taper 3 took effect in April. Again, you could hardly see a change. And now we have taper 4, which I'm not sure exactly when that'll be effective, probably in May sometime. And the slope of the line will gradually begin to slow down. But as you can see, stock prices have already gone into a trading range here. So with liquidity continuing to be pumped in, I think it's only a matter of time before the stock market probably breaks out through these multiple peaks here and makes another run to the upside. Right now on the cycle projections, I have tentative projections in the 1930, 1940 range over the next couple of weeks. One of the things that we've been talking about here on these podcasts is the immense amount of liquidity that was pumped into the market by the Treasury paydowns in April, something like $91 billion last week. And it seems to me that most of that cash was not committed. We would have seen some response either in the Treasury market rallying or in stocks rallying. We've got a little bit of a rally in stocks, but having seen these things before, my sense is that most of the cash is still out there. And that with the Fed not changing much of anything, that the market, that investors and the dealers will find some excuse to push it through the highs and get that blow off that I was looking for in April. We may still get it in May. And then the old adage of sell in May and go away probably takes effect beginning in the second half of May or early in June, as most of that liquidity gets committed. And then the Treasury begins to borrow more money in the second half of May and early in June. That happens because they're taking in less taxes and the outlays can continue at the same pace. So there'll be a little more pressure on liquidity in the second half of the year than there was in the first half. Beware of mid-June and mid-September when quarterly taxes come in. Those collections have been pretty strong, and it doesn't seem like the economy's momentum is changing that much, notwithstanding the slowdown in GDP in the first quarter. I think that number will be revised up. So this stuff is going to continue for as long as this liquidity continues to be pumped in. As far as when the unintended consequences of the Fed's action will rear their ugly head, I'm just going to take a guess based on cycle analysis that it'll be within the next 12 months, and something will occur, whether it be booming commodity prices or something else, that forces the Fed finally to stop this pumping altogether. And at that point, we're going to see the market have a pretty big adjustment. There are tremendous distortions that are being built into this market, and at some point, the price has to be paid for that. So that'll do it for today. I hope you enjoyed this video presentation. I'm going to try it again on Friday. And before that, if you have any suggestions or questions or anything you'd like me to address, just send me your feedback via the feedback form on radiofreewallstreet.fm or on wallstreetexaminer.com, and I'll try to get to your suggestions as we go along. So until Friday, have a great couple days, trade sane, and I'll see you on Friday. This has been Radio Free Wall Street with Lee Adler. Find this program on the web at radiofreewallstreet.fm or wallstreetexaminer.com.